Investors are sniffing out the fact that we might be in the most pro-business economic climate going forward since the days of Ronald Reagan. And it's so amazing that we could see Dow 20,000 just as the Fed is actually raising rates and moving off of this 0% interest rate policy that has plagued savers for so many years since the financial crisis. And it is reason for optimism, Neil, because look, there's about $50 trillion, depending on whose math you look at, in cash on the sidelines. Before the financial crisis, a 6-month CD was paying about 5%. Today it's paying about 1%. So for savers, retirees, people trying to fund education expenses, it's really good news. And it's also good news because it's money that gets spent in the economy, and the consumer certainly drives the economy. So you made a really good point. People are deferring capital gains. Tax loss selling candidates, weak stocks, become great opportunities this year, more so than most years, but recognize rates potentially are going up. We're in this sea change, and that's good news for everyone except for interest rate sensitive areas and maybe for the real estate sector, which really relies on cheap money. Look, you don't want to lose your head and recognize the Trump trade, the financials that are running, the industrial stocks that are running, that will be tested next year. But valuation really does matter. So we want to be incremental, recognize that maybe January, February, we get some disappointing news. That'll be an opportunity to put some money to work. Look for bargains in the market. Don't necessarily chase what's running right now. There's plenty of opportunities, high quality multinational companies that have been left behind in this rally, some big technology names. That's a place to start to build your portfolio. Look through the rubble, look through what people are selling right now, and then buy on weakness into next year. And of course, be disciplined about it and be incremental.